Good morning and welcome to your Friday, April 26th market news update. Bank of Japan stands pat and keeps rates unchanged at 0% in their April meeting. The Fed's favorite inflation metric, the Core PCE index, lands in today's session. Oil and gas giants Chevron and ExxonMobil delivered their Q1 earning results. Alphabet and Microsoft toppled earnings expectations and rallied in aftermarket hours. The yen tumbles to fresh 34-year lows as BOJ said to expand bond purchases. Seng index climbs to 4-month highs as effects of Beijing's stimulus actions bear fruit. US stock markets pivoted swiftly from negative territory and finished the day in the greens. That's all for now, and thank you for watching.
Hi everybody and welcome to another daily presentation. This is the market overview for the 26th of April of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. Now, the first topic of conversation is going to be about the Bank of Japan and the subsequent move in regards to the yen. So in early today's Asian session, the Bank of Japan decided to keep the policy rate unchanged at the 0% level as widely expected, taking in a sense a brief pause after delivering their first rate hike in over 17 years in the prior meeting. Now, the initial reaction in the FX market led to the extension of the deterioration of the yen, which has shed more than 10% of its value against the United States dollar since the start of the year and has now fallen into fresh 34-year lows. So at the press conference, the governor of the central bank, the Bank of Japan, Kazuo Ueda, did not provide solid guidance as to how the central bank will move forward or whether additional hikes will follow and when, which has indeed encouraged yen traders to carry on with their plans, adding more pressure on the safe haven currency. Now, the discrepancy of interest rates differentials between the Bank of Japan and other major central banks allows traders to speculate that the yen is and will be prone for further weakness as long as authorities do not intervene. And we highlight this since international traders can and are in fact borrowing funds, quote unquote, for free from Japan, and they deposit them into interest yielding accounts in other central banks, in other economies, or in a sense abroad for a profit. Now, the yen currently hovers around the 156 range against the greenback, the United States dollar, amidst a highly volatile session. It is in collision course with the $160 range, which serves as the next solid, quote-unquote, hurdle for yen bulls. Now, nevertheless, yen traders remain vigilant and somewhat nervous since the current trading range has been declared as an intervention zone many times again in the past from the nation's finance ministry, which sits on the sidelines and, in a sense, patiently monitors the situation. And, in a sense, market participants are anticipating a reaction from them, and because we have heard them in the past vowing to restore in a sense, order in the FX market should speculators carry on with their bets against the yen. So finally, a paradoxical reaction was observed in the Japanese stock markets as well, which were expected to rally from this weakness of the yen. However, that is not the case. We see them staying at the same levels that they were yesterday, which are somewhere near the 2-week high range. However, deterioration of the yen is expected to continue moving towards lower territory, if you will like, which from a fundamental standpoint of view, we expect to see equities rallying from that. We will see when. Okay, so Enough about Japan and yen. Let's move on to the next topic of conversation, which is the main focus of today's session, which is the Fed's favorite inflation metric, the Core PCE, which is inbound later today. So without a shadow of a doubt, the main attraction of the day is the Fed's preferred measure of gauging inflationary pressures, the Core PCE index, since it has direct implications on the central bank's plans moving forward. Now, according to forecasts, the headline year-on-year reading for the month of March is expected to downtick by 0.1% from the 2.6% level down to the, 0.2% from the 2.8% level down to the 2.6% level. Whereas from a month-on-month point of view, we see a much different picture. Inflationary pressures are expected to stand pat, not move in a sense, and not make any sort of positive development and stay still at the 0.3% range. Now, should the actual figures match expectations, that could be decoded as another demonstration that inflationary pressures in the United States are indeed sticky, albeit the projected slowdown of the core CPI rate. We will see, the core PCE number. We will see whether that is going to come hotter or cooler than expected. At the end of the day, the fear that FOMC policymakers have that inflation may be becoming deeply entrenched within the US economy is maybe coming to fruition or turning out to be the base case scenario if we continue to see inflationary pressures not falling rapidly back towards the bank's 2% target. So the failure, or we make a different case here, so the failure of inflationary pressures to ease at a quick pace and march towards the bank's 2% target may entice the Fed at the end of the day to prolong their current on-pause kind of mentality for longer and thus postpone the highly anticipated pivot towards looser monetary policy conditions. We have seen the deadline for a cut being pushed back many times throughout this year. It was March initially, then it turned out to be June, and now from June we went to September. Again, the outcome is going to highly rely upon the result of today's session. So on the other hand, should inflation showcase signs of material cool down in today's session for the month of March, and in a sense fall below the 2.6% level, we would reasonably expect to see the prolongment of this kind of euphoric mentality that kind of comes out from United States stock markets. We also expect to see the dollar falling on the back foot and the calls and talks for more than 2 cuts gaining some sort of momentum and traction once again. For the time being, we will see. We highlight this event for today's session. We also advise caution trading around these kind of events. But again, for the time being, this has been the end of today's session, guys. Thanks for watching, and we'll catch you on to tomorrow's session, Monday session, for another hopefully brief update. Take care. Bye-bye.
Everyone, and welcome to the earnings season section. And today we highlight the releases from Chevron and ExxonMobil. Chevron explores, develops, produces, and transports crude oil, but also provides liquefaction, transportation, and regasification services for natural gas worldwide, and is the second largest integrated oil and refining products company in the energy industry according to market capitalization. Analysts forecast that Chevron beat its earnings per share target by 23 cents in the first quarter of 2024, yet missed its revenue target by over $6 billion. Point of interest will be the impact on the company's refining and production performance. Optimistic oil consumption forecasts for upcoming quarters to benefit Chevron. ExxonMobil engages in the exploration, drilling, refining, and production of crude oil and natural gas internationally and is the largest player in the energy industry according to market capitalization metrics. Analysts forecasted ExxonMobil beat its earnings per share target by 27 cents in the first quarter of 2024, yet missed its revenue target by minus $4.4 billion. Point of interest will be the integrated oil and gas growth trajectory of the energy giant. ExxonMobil's dividend yield makes an attractive investment opportunity. That's all for now, and thank you for watching.
Today, we're going to be covering, in a sense, the topic of moving average, convergence, and divergence. We're talking about a technical indicator now. Okay, we covered this topic in the past, the fundamentals behind it, what kind of information does it convey, what are the parameters, how to interpret them, and all that kind of stuff. We covered that in a past webinar. Fear not, for those of you that have not joined this in the past, you can actually view it online. But again, fear not, we're going to do a small recap today to refresh our memories. And as we progress through this webinar and we introduce these kind of concepts, we're going to go on a live environment together to see how you can actually, if you would like, get some sort of ideas of how to interpret these kind of results or these kind of indications in a live environment. We're going to chat together. You're going to give me, hopefully, a few answers or instruments that you would like for me to go over. And again, if you have questions, send them through and we will go at this together. It's going to be much more interactive by the second half of this webinar, okay? But from the beginning, we have to also remember that many people have not seen this before, so we're going to reintroduce it, okay? So I see John, Nicholas, Ricky, Olu, or Elias, I'm not sure which is your first name or not, man. Apologies. We see Michaela, we see Vladimir, Nata. Again, welcome, guys. Okay, so this is going to be another webinar in regards to technical analysis. This is the second path we have taken. We're going to focus on technical analysis, moving average, convergence, and divergence. Oh yeah, I forgot to make the checks. Please, guys, please let me know in the chat whether you can actually hear me. That would be nice, because if you don't, I would have spent, 5 minutes talking to myself. Please let me know whether you can hear me loud and clear, whether you can see the first slide of the presentation, and we'll be shortly on our way. Please give me a thumbs up, and we're on our way, okay? Thanks for the confirmation, Nata, Olu as well. Thank you, guys. So let's dive right in. After, I'm going to read a small risk warning and a disclaimer. Please bear with me for less than a minute, okay? Hopefully, I'm going to do less than a minute. Let's see. So the risk warning is our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. Now, these products may not be suitable for everyone, and that you should ensure that you understand all the risks involved. Now, the disclaimer is the information in this webinar shall not be considered as investment advice or investment recommendation, but it is for educational purposes only. This material is just a personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. T4Trade is not responsible for any loss arising from any information contained herein, and the redistribution of the material is strictly prohibited. Okay, out of the way, let's get started. Okay, so let's briefly remember what we covered in the past, what we will see in the future, and what we'll be concerned with in today's session. Okay, so in the past, I've decided to split this kind of whole series into two segments. Obviously, the one is fundamental, the other one is technical, and below the technical stuff, I've decided to split again into two categories. We have mechanical analysis, and we have here listed a bunch of different indicators. Certainly, these are not all of them. There's, I don't know, hundreds of them out there. I've decided to choose the ones that are more easy to introduce to beginners, okay, or intermediate traders or professional traders, those that do not know this kind of stuff. Okay, super simple, easy to comprehend, easy to apply to your chart and start using them immediately. Okay, this is the reason why I've chosen to this here. Okay, so on the chart, remember, we're talking about mechanical analysis, so we're talking about indicators much more broadly, oscillators and all that kind of stuff. So on chart, we have covered in the past the moving averages, Bollinger Bands, and Fibonacci retracement, which is going to be on our next session. Okay, and off chart indicators, the ones that actually go below. Okay, on chart, for those that do know, those are the indicators that you apply on your chart and go on top of price action. So it's going to be middle with the price action, the candles in a sense. Okay, whereas off chart indicators are the ones that go below it. Okay, so both of them, all of them are actually technical indicators. Okay, some of them give you different indication, are concerned with different aspects, but still they are used for technical purposes. Now, again, off-chart indicators we covered in the past, relative strength index, the RSI. Today and in the past, we covered obviously moving average convergence and divergence, the topic we will be focusing on today. And we also have average directional move. Hopefully, we're going to do this in the future, and momentum, this is much more general and vague, but still, these aforementioned indicators encompass some sort of elements from momentum as well. So you will get the idea as we get there. Okay, so enough about this. Moving average, convergence, and divergence, also known as MACD. Okay, so what is the definition? Let's go through the basics. So in a sense, the moving average, convergence, divergence is an indicator. It's a trend following indicator. Much more accurately, it encompasses or uses momentum. Okay, so we will be primarily concerned with this aspect, okay, today, that measures the relationship between two moving averages. Again, no, you don't need to be a genius to understand this. Moving average, convergence, and divergence, obviously, it's going to have moving averages in it, okay? Obvious. It is used to spot changes in the strength, the direction, momentum, and duration of the trend of any given instrument. Okay, we're talking about instruments price. Now, once it is added onto the chart, it can be found at the bottom of the price chart. Again, as we can recall from a prior slide, of chart indicators, since it is an oscillator, okay, which is essentially measuring the strength of the prevailing trend, okay, along with signals of the change in the trend. And this is what we care about, okay? We use this indicator in order to spot when those kind of shifts in the direction appear or happen, or what kind of signals are we actually getting? Is it going to be an imminent switch in the direction of whatever instrument that might be, or the trend will continue? These are indications that you can draw conclusions from while studying or while giving attention or paying attention to moving average, convergence, and divergence, okay? So it can also be plotted as a histogram, which moves above and below the baseline. We will discuss what those terms are. In a sense, they show strength and weakness in price, okay? So the MACD is used by all types of traders, such as, more accurately speaking here, more technical traders, okay? Some do not use technical indications at all, fair enough. But when we talk about technical traders that are actually concerned with technical indicators or using technicals, or actually traders, most of them use this kind of indicator, or at least pay attention to it once in a while. Yeah, they know the importance of this kind of indicator, okay? So it is used by all types of traders. We're talking about position traders, swing traders, day traders, scalpers, you name it, okay? And this indicator can be applied at any given time frame in any given instrument, okay? So you can apply this usefulness of this indicator or on any time frame and any instrument you would like. The point here is to understand the principles and how does it work. And once you understand that, you can extrapolate and make scenarios of what's going to happen with price action if you learn how to interpret these results accurately. Okay. Something else to remember: the MACD is based on moving averages, and is therefore, this is written with bold letters, with capital letters, with red letters. Okay. It is a lagging indicator. Okay. It uses information that was compiled from the past. It does not give you future hints about where the price action is going to move towards next. It's not forward looking. Okay. It's a lagging indicator. Again, because it uses moving averages, where moving averages use a compilation and averaging of a specific period of price, okay, in the past. So this is not giving you indication where it's going to move towards in the future, giving you indication where it has switched or it will go, or whether it is continuing, been continuing to move to that specific direction. Okay, so we're talking about identifying stuff that happened in the past. They're not giving you indication of what's going to happen in the future. Okay, so bear that in mind. Okay, furthermore, the MACD is less useful for instruments that are not trending or are trading erratically. Okay, and this, again, it's pretty much obvious. In order for MACD to work, quote unquote, perfectly, you need to have swings. Okay, but in the grander scheme of things, at a specific direction, okay? Either when the market is moving upwards or downwards, when it's moving on a sideways fashion and you see congestion of price action or inability to spot where the trend is actually moving at, MACD is not going to be that useful, okay? So you need a prevailing trend, okay? A major, quote unquote, trend, okay? And a direction in order for the MACD indicator to be much more useful, okay? So, and the other thing is trading erratically. I think we've all seen erratic kind of movements in many instruments, but there are some that are actually infamous for their erraticality or crazy volatility. I don't know. In my eyes, crude WTI is one of them. I've been looking at this wild kind of instrument for quite a few years now. I'm convinced that if the market wants to push the price towards one specific direction, given whatever fundamental view is there, fundamental data is out there, they will do it quite fast and they can catch you off guard. Okay, so we're talking about erratic movements. Okay, this applies also to small cap stocks that I don't know, pump and then just vanish overnight. Again, that's another area of instruments that might not work as well, but in the majority of instruments it works quite decently. Okay, that's why we're introducing it. So the moving average, convergence, divergence, it takes two trend following indicators, and this is, remember from the past we discussed moving average, more specifically moving average strategies. Okay, so you remember that these again are lagging indicators, okay? And the prime objective, if you would like, or the prime usage, the reason why you use them on your chart is to identify clearly where the price action is heading towards to. In other words, identify the trend. That is why you use them, okay? So the moving average, convergence, divergence, the default settings of the moving average, convergence, and divergence is a 12-period exponential moving average, or you can do simple moving average. Don't mind that. Okay, so you have a 12 period and a 26 period, okay, moving average, okay, and thus turns them into a momentum oscillator by subtracting, okay, the short-term EMA from the longer one. Don't be confused. If you're actually confused right now, please bear with me for a second and you will understand what I've just uttered, okay? So in a sense, you use two moving averages, one is short and one is long, okay? And the moving average convergence divergence as an indicator, okay, calculates the difference between the two, and this is given by a line below your chart in the MACD box, if you can see there, which is called the moving average line, the MACD line, excuse me, MACD line. And the other one is the signal line, which is a 9-period exponential moving average. You will see them soon. I have a question from Olu. What is 12 and 26 period EMA? Okay, so if you know what moving averages are, okay, 12 is essentially the sample size, the period where the moving average is compiling the information from, and the 26 is exactly the same thing, but with a longer time period, okay? So 12 and 26 are the default settings of the moving average convergence indicator that have been studied from empirical data for the, I don't know how many decades now, and they have been proven, quote unquote, to work as, if not maximally, has a maximum kind of efficiency, okay? So if you know what moving averages are, which is, again, I'm going to do a small recap. Moving average, in a sense, is an technical tool that, in a sense, averages out the past X amount of periods or days or whatever that means, minutes, whatever that is, okay? Compiles them together. So you have a value from 1, 2, 3, 4, 5, 6, 7, and 10. Add them all together and divide them by their number of period, which is 10, gives you the average. This is the moving average, and it changes over time because it uses different, okay? It adds on a new day and subtracts an old one, okay? So this is what exponential moving average is, in a sense. Gives much more emphasis on, if you assume that we have a 12-period exponential moving average, okay, that means the EMA, the exponential moving average, is placing much more weight. It's averaging out all those 12 values, but is giving more weight on the values, for example, 9, 10, 11, and 12, okay? So the latest stages of the price action, in order to capture best the swiftness and the swiftness of the movement of moving averages. Okay, that's all in a nutshell. Okay, so if you have questions, you can actually watch the prior webinar and clear this out in your head. Okay, so when continuing on, when the MACD line, okay, again, we have three components in a sense. We have 12-period exponential moving average, a 26-period exponential moving average once again, and the 9-period signal line, okay, which we're going to visit now. Three aspects or three components of the moving average convergence divergence indicator, okay? So when we have the MACD, okay, and the MACD line, in a sense, I'm going to repeat myself, is the difference between the 26 and 12. You're not calculating this, okay, manually by yourself. If you switch to your trading accounts right now, your trading platforms right now, and you select to apply the moving average convergence divergence, and you pull it for in the parameters, short moving average is going to be 12, long moving average is going to be 26, and the signal line 9. The whole thing is going to be calculated automatically on your chart, okay? And you can clearly see that you're not going to be doing any manual work, for those of you that are asking this, okay? So coming back to our topic, when we have the MACD line crossing above 0, it signals positive momentum. And if you can see the slide on the bottom half of the slide, where you see the switch between, hopefully you can see my mouse here, okay? When he says, when the MACD crosses above the zero is this line over here. You see where you have green histogram bars, and then red, and then green, and then red, and then green, okay? So the 0 line, okay, is the basis where we identify, in a sense, the shifts in price action, okay? And it gives you an indication. Either when you get, in a sense, when you get positive values, that means you have green, okay, histogram bars, okay, you can see right here. That means there is positive momentum. This is the purpose of the histogram bars. Okay, whenever it's green, that means there is positive momentum. Wherever it's red and below, obviously, the zero line gives you an indication that there is bearish momentum. Okay, you're going to see it visually illustrated in a much nicer way in the upcoming few slides. So please bear with me. Okay, so again, recapping, when the MACD line crosses above zero, so green histogram bars, it signals positive momentum. And when it falls below zero, it indicates negative momentum. Those are the two key takeaways that you need to extract from all these kind of things I've just mentioned. Okay, so above zero, positive momentum, below zero, negative momentum. And momentum is one aspect of the entire thing. And all the pieces will fall into place. Please bear with me. Now, the trigger line, I'm giving you a different name here. Most people know it as a signal line. This is the one I mentioned. Okay, it's a 9-period exponential moving average of the MACD line. You will see its usefulness. Now, when you have crossovers, I mean, that means one line is cutting above or below the other one. It has certain implications, or it signals specific things. Okay, and you will understand what I mean by this. Now, crossovers between the trigger line are used in a similar fashion as crossovers between two moving averages. So we covered this in the past. So let me explain what I mean by this visually. Okay, again, this is a visual representation. Obviously, on the top half, you have price action without numbers. We don't care about the instrument or the value, okay, the price that it has. We care about what information is conveyed, okay, while having the comparison below with the moving average convergence divergence indicator, okay? So you can clearly see here a downwards kind of fashion movement, okay, and a quick and rapid burst of alteration, so crossovers between lines, okay, and you will see and study what each and every one of those lines are, okay. So on the top of your chart, you can see the 26-period exponential moving average, the black line, and the 12-period EMA exponential moving average is what is this? Purple, pink? I don't know. So again, something else to remember, obviously the shorter time frames, okay, the shorter period exponential moving average, in this case, the 12-period exponential moving average, okay, fits much more nicely the price action, okay, you can clearly see here, compared to the longer term one, which is the 26-period moving average. So even if I didn't give you, for example, I did not give you which is which, you reasonably assuming you would have came to the conclusion that the one that is actually fitting nicely is the short one, and the other that is much more smoother in a sense is the long one, okay? So if, for example, those were away and not there, you could have observed that and would have come to the conclusions by yourselves, mainly because of how closely those moving average are fitting on top of price action, okay? To the untrained eye, after a while, you will get this straight away, okay? So those of you that are actually struggling with this. But still, again, 26-period moving average, black line, exponential moving, 12-period moving average is the purple line. So we care about whenever you have crossovers between the two, okay? When does the purple line we start always with a small one, okay? We have to always pay attention firstly to the small one, and in this case is the purple line, the 12-day moving average. We care about when does the 12-period moving average crosses above the black line, okay? So when does the purple line cross above the black line? This is one aspect that we will pay attention when it comes to moving average convergence and divergence as an indicator. And you can clearly see it below down here. Let me get okay. These are moving averages that go on top of the price action. Below, okay, in this area, where is the pointer? This one, okay, is the indicator. This is the moving average convergence and divergence. This is the MACD that goes below your chart. This is the one we care about now. So the blue line is hinted right here. Where is the mouse pointer? Give me one sec. Okay, it's here. Okay, the MACD line is, I've lost it again. What's going on here? Yep, here. Blue line is the MACD line. And again, the MACD line is the difference between the 26 and the 12. This is how it's calculated. It's calculated automatically by the indicator. Okay, so this is one aspect, and the other one is the signal line. Signal line, as we just mentioned, is a 9-period moving average. Excuse me, exponential moving average in this kind of case. So we care about when does the blue line, which is the MACD line, where is the MACD line crossing above the red line? This is what we care about, and this is where we pay attention to. Okay, so whenever you see crossovers between the two, something else you have to keep in mind is that obviously the bar is going to be flat, and you can clearly see here that you have no sort of value at the time of the crossover. That means there is a shift in momentum from bullish, in this kind of case it was bearish, to bullish. Okay, and this is the stuff that we are actually looking forward, okay, to identifying in a sense. So in a sense, this is what we call a bullish crossover. This is, in a sense, the signal that it's time to buy. Okay, crudely taking only the moving average convergence divergence by itself. So whenever you see the blue line crossing above the red line, much like here, this is what we call a bullish, terrible with this, crossover, CO. Okay, that means pay attention, okay, because the price action is going to probably move to higher ground. Obviously, you are waiting for confirmation, but still, this is an entry signal. This is a buy signal, okay? And the opposite is also true. Whenever you have the blue line, where we go, whenever you have the blue line, let's take this example right here, crossing below the red line, the opposite in this kind of case, okay? This is a bearish crossover, okay? So that means bearish, yes. That means it's a sell signal, okay? That is the quickest way to conceptualize, but also understand what kind of information does the moving average convergence divergence line tells you, okay? Indicator tells you, excuse me. So again, at the crossover point, you have flatlining histogram bars. Again, it signals the shift in sentiment, it signals the shift in momentum. And you can clearly see here, positive, and then turning negative. And does this, you have to ask yourself now, does this correspond with price action? Let's see. So at this point in time, we said that it's going to be a sell signal because the moving average convergence divergence indicator, the moving average convergence divergence line crossed below the moving, below the signal line. The blue line crossed below the red line. This is the area where this happened. This is the signal, and this is what followed. Okay, same kind of case here. Crossover of the moving average line above the signal line, blue line above red line, bullish signal. Where does this correspond to? I know my hand movement is not that nice. Okay, maybe somewhere in here. Okay, signal for going long. Obviously, this kind of case flatten out quite quickly. Okay, something else to pay attention to. Okay, but it gives you the indication that is actually going to move north, which is going to move to higher ground. It actually did, even though it did for a very short period of time compared to, obviously, this, relatively speaking, obviously, compared to this kind of crossover. Okay. This is, in a sense, in a nutshell, what the moving average convergence divergence indicator is telling you, and what this is, what these are the signals that we're actually interpreting whenever we see these kind of crossovers. These are the stuff we are actually looking for in order to apply this specific strategy, or either buying or selling, depending on what's going on with the price action. Okay, we're looking for these kind of indications. Many other things are also we need to pay attention to. Some of them are, yep. How tall or how short, okay, these histogram bars are also other indications that we look for besides the crossovers. Okay, there's another one here. It is a rule of thumb whenever you have acceleration in momentum, okay, you're going to get steady, okay, and incremental rises, or in a sense, larger bars one after the other, okay, which signifies that the bullish sentiment in this kind of case is actually accelerating at a fast pace, and price action is actually moving with a much more rapid pace towards the upside. It's gaining much more momentum and is moving fast, okay, compared to a period like let me get something like this, okay, this area you see stalling here, okay, compared to this. Rising histogram bars gives you an indication that price action is accelerating, okay, and in this kind of case the signal was somewhere in there. Enter long, hopefully somewhere in there, capitalize on the upside. Okay, so this is something else you pay attention to. You also pay attention to the crossovers of the lines, not only between themselves, but also with the bar. Okay, there are different parameters that you need to take attention to. For example, in this kind of case here, we saw, again, what is this? This is a bullish crossover, okay? Bullish crossover, blue line above red line, indication, shift in trend, okay? Has actually happened, okay? So this is somewhere in there, okay? Let's say it's here, okay? This is the first step. What we care about, we got the signal, now we want confirmation, okay? So in order for me to be fully convinced, I'm looking at how the development goes on with the bars. If the bars are incrementally rising one period after the other, very good news. That means the price action will accelerate, or it is actually accelerating as we speak. And you see big candles, okay? Clearly see them there. Coincides with the rise of the histogram bars, obviously, because it measures this kind of shift or pace in price appreciation. Okay, something else to pay attention to. Okay, let's say that you got the signal and you are waiting whether to enter or not. Valid signal, additional signal for me to enter would have been this lovely big green candle. Okay, that gives you an indication. Super nice bullish momentum. Price action could move to higher ground at a much faster pace from here on, and therefore I pay attention to this level, and let's just say I buy here, okay, after I get the confirmation that the shift has actually occurred. What else I'm paying attention to is this crossover right here of the blue line above, okay, what we call, where is it? The zero. Okay, this is what we care about. Crossover of the blue line above the zero line down here signals once again extra bullish confirmation that the price action will move to higher ground. And if you pay attention closely, and if you have been paying attention closely, you would have realized that whenever you see the black line, the blue line and the red line crossing above the cutoff point, the 0, okay, you can remember this as 0 point or cutoff point, okay, switches between bullish and bearish. If you track that on your price action, you would have had the moving average by itself, 2 moving average lines, okay, cutting, okay, another bullish crossover here with the traditional usage of moving averages by themselves, okay. So moving average convergence in divergence is 2 moving average lines, but the MACD has also a hidden kind of capability, or a secret kind of capability, which is not secret, it's obviously out here spelling it out for you. Their momentum, and this is the extra added point. Imagine MACD as moving averages, okay, strategy, using moving average strategy with momentum. That's certainly it, okay. This is, in a nutshell, what moving average convergence and divergence is. You have the principles that apply to moving average strategies. We're using 2 moving averages in addition with in addition with momentum, okay. This is what moving average convergence divergence is in a nutshell, okay. So let's go back to the, let me see what else do we have here. Okay, technical narrative, but we have to go through it, and then we go on a live environment, okay. So again, recap. The indicator shows a blue line and a red line, okay, and the histogram, we covered this. We calculate the difference between 2 lines. This is, we're talking about MACD line here. Values are calculated from the price of the trading instrument in the main part of the graph, blah, 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 okay. So the MACD line, again, blue line, is the difference between this and this, 12 and 26. By the way, you can alter the periods of the moving average convergence, divergence to your liking. Do not take this as a rule written in stone. Play around with the time periods. You can do whatever you want. The point is, you have a short one and a long one, and the principles are the same. The rationale behind it is the same. It works the same way, okay. The reason why we use 12 and 26 again is because of the empirical studies that proven over the period of, or decades now, that these are pretty decent at doing their jobs, okay. They give you decent signals, okay. They're not perfect, but they give you, okay, nice signals, okay. So the other one, the aspect is the red line. We covered this as well, which is the 9 period and the histogram, okay. From these kind of slides, we've actually covered this live on the illustration. Let's see. What about exponential moving averages? Okay. So who asked the question about the EMAs before? Oliver was. Yep. So highlighting recent changes in trading instruments price. Okay. The EMAs. By comparing EMAs of different lengths, the MACD line gauges changes in the trend of the instrument by comparing differences in the change of that line to an average, okay, which is what we care about in order to identify subtle shifts in the strength and direction of an instrument's trend. This is what we care about with MACD line, okay. So again, I'm probably going to repeat myself here. Traders recognize 3 meaningful signals in terms of moving average convergence and divergence. When the MACD line crosses the signal line, we're talking about this blue line cutting above red line. The other meaningful signal is when the MACD line crosses the 0 or the cut-off point, okay, which is this instance right here, okay. First one was blue line above red line. Second instance is blue line, MACD line, crossing above the 0, the cut-off point, okay. And the last signal there is divergence. It's a little bit more advanced here, but still, between the MACD line and between the histogram. In a sense, we're talking about this. Okay, you can clearly see here. This is what we call divergence between the two. The histogram bars, okay, are above, or they are larger, if you would like, in this larger, they're not larger, but because they not study the same thing. But the histogram bars are above the signal line, okay, or the MACD line in this kind of case. Okay, so this is another one. This is what we call the divergence. This is, in a sense, this kind of case here. Sorry for all the gibberish and scribbles all over the place. Hopefully I didn't confuse you. So there's a difference, okay? MACD line, this area right here in general. So the histogram, the moving average line, the MACD line, the blue line is certainly below, okay? Or the histogram bars are above the MACD line. This is what we call divergence. And the larger the divergence, okay, the larger the distance between the two, okay, the faster the price appreciation will probably be on your chart. Okay, you're gonna have much rapid pace of price evolvement or price appreciation. Okay, this is what, in a sense, this whole thing is about. What else? Graphically, this corresponds to, red line crossing the histogram, blue line crossing the x-axis, and higher highs, higher lows. We're gonna see them on a live environment soon. Okay, what time is it? Okay, we have 15 minutes to cover the whole thing. Hopefully we're gonna go over single line crossover. Yeah, we covered the whole thing when we went over the narrative here. Okay, so there's no additional value of information in this kind of slide. So therefore, let's skip it and let's go on a live environment in order to do this whole thing together. Now, let me see. Let me get my charts up and running. Maybe 1 second, guys. Again, if you have questions, please send them through. I have one on the chart. Give me 1 second, guys. Shiv, yeah. Do you email webinars at T4Trade? If yes, I have not seen an email like this. Let me double check, however. Okay, yes. Okay, so we're talking about webinars at T4Trade. Okay, let me double check. Yeah, okay. So, yeah, I will give you an update, Shiv, okay? Let me get the chart up and running because we're running a little bit late. That's common theme here. Obviously, my fault. So let me pull up this chart here. What do we have? What is this? S&P 500. Let's go S&P 500. So remove drawings. Let's start from the beginning. Okay, let's go on a much shorter time frame. Even though daily chart will actually work pretty well as well. I like to use MACD on a daily chart rather than any other period. Obviously, up to my liking, you can adjust accordingly. Okay, I like to see the macro kind of trends rather than the short ones. But also, if you can zoom in, if you can use the macro and then you zoom in into the shorter time frames, again, you have in mind that, you know what, primary direction of the market is moving downside. To the downside, and in the short term I see bullish signals. How reliable are they? Okay, if you have that on the back of your mind, you have a small parameter adjustment, if you will, like, in your approach. Okay, knowing that the primary trend is moving to the downside and your assessment is giving you signals for an upside, pay attention to this, okay, because the reversal might be paid. So what do we have here? It's S&P 500, one of the most traded instruments, if not the most traded instruments out there, SPY. Let me check my parameters first. So Oh, I have them over there. Sorry. So you have moving average, exponential moving average, the 12 period, which is what color? Trick question. Okay. So if this is a 12 period moving average, exponential moving average, it's obviously going to be the one that is close to the price action. Again, hopefully, not hopefully, it's certainly the black line right here. 12. You see how nicely fits on top of price action. And the 26 is the long-term moving average. Okay. So in a sense, I've applied the same settings, if you will like, on two moving averages. Okay. And this here below are the moving average convergence divergence with RSI, which is messing the whole thing up, but still it's going to be important. So let's keep it there. You'll see what I mean soon. Okay. So moving average convergence divergence is down here. Remember, we have the blue line and the red line. We also have the histogram. We also have the cutoff point. Those are the aspects of the moving average convergence divergence indicator we have outlined in this webinar. Okay. These are extra. What can we see from here? Let's start from the beginning, use our tools in order to find the crossovers, okay, on the price action, okay, or using the MACD moving average convergence and divergence. Let's zoom in a little bit more, okay, and identify where you see the blue line crossing above the red line, or the red line, or the blue line crossing below the red line. So give me a sec. I'm gonna how can you make this line a little bit much thicker? Not sure. Hopefully you can see it here. Okay, side visibility. Never mind it for now. Hopefully you can see the crossovers. So one, my eye, it has actually spotted quite quickly is this one here. Okay, that is certainly one. You see the blue line crossing above the red line. That is a cutoff point that I will be paying attention to. Other one is this one right here, blue line crossing, or what is the fastest way of identifying the crossovers? You search for this. Okay, whenever you see the momentum, okay, switching from bullish to bearish, and you get a zero value on your cutoff point, again, zero, okay, this is where it denotes there has been a crossover of the blue line and the red line. Keep that in mind. Okay, so another one is here, clearly see here, another one is here, another one here, another one here, another one here. Okay, so remember, whenever the blue line crosses above the red line, bullish. Whenever the blue line crosses below the red line, bearish. And this kind of case right now, we can see the blue line, the MACD line, peaking and starting to point south. That means there might be at bay, okay, a crossover, a bearish crossover between the MACD line and the signal line. So let's not go into the much recent ones. Let's go and evaluate what's going on with the past for the time being. So we have outlined the crossovers. Let's see where does this coincide, quote unquote, on price action. Okay, so let's use this. This is a crossover. I'm denoting the price change. Okay, this is, where is the other one? The other one is somewhere in here. The other one is here, approximately or roughly. Okay, other one is somewhere in here, and this one is here. Okay, so we have outlined when using the MACD indicator, when, okay, the signal was given by the MACD indicator, and we identified on the chart to see whether to assess whether this kind of indication is valid or not. Let's see. So bullish crossover down here. So this one gives you a bullish sign. Therefore, let's, for experimentation purposes only, use this kind of signal, for example, as a valid entry point. Okay, let's assume that the signal was given at that specific point in time, and I saw it right at the time that it happened, and I entered a long position blindly, because you are entering actually a position blindly. Okay, so where would have been your best target to exit using only moving average, convergence, and divergence, and no other indications, for example, RSI or moving averages, or the simple stuff, support and resistance levels or trend lines and all that kind of stuff. Only using MACD line, where would have been the next signal for me to exit the position? It would have been at the next crossover point, okay, which is where the blue line crosses below the red line. And this is right there, okay? So let's assume that you are using the crossovers for you to enter and exit positions, okay? That's one way of going at things, okay? Using the crossover points as one as entry and the other one as exit, or entering the position short and covering your position with a long position, closing it, okay? So that's one way to do it. Would have been somewhere in there. Let's see how much potential you could have had made in regards to using this kind of signal. This is roughly, obviously, yeah. So we're talking about from here until, let's just say there, 1.65, okay? Obviously, much nicer return up there if you have paid attention to the price action, okay? You're using any other different system or method. That is one, okay? How about this crossover right now, okay? So this, in a sense, if you miss the whole thing, or if you actually entered here and exited here, this is a bearish signal in play. That means place a short order there, right there. So let's do a short order right there, and let's say it's somewhere here, okay? Or at the worst, let's just say there, okay? Where would have been the next point of exiting my position? Would have been at the next crossover point, which is, as we identified, down here, okay? So much nicer profit opportunity in this kind of case, okay? Come on. Okay, somewhere approximately there, okay? What is the payout for this? What is the probability of making money here? What is the high percentage? 5.5%, approximately 5.5%. Very, very decent, okay? So now that we have covered our position, let's go short here and long there in order to cover your position because you went short. This is now still a bullish crossover signal. That means enter a long position. And in a sense, you have got the gist that what I'm doing right now is what swing traders are actually doing. This is basic one-on-one swing trading. This is what they're actually doing. They are playing the crossovers, okay? That's one way of going at trading. You can do this pretty much simply by yourself, okay? Easily. How easy is this? Okay, so bullish crossover, I wait for the confirmation, enter a long position, okay? And I wait for the next crossover. Where is it? Up there. Where is the profit opportunity in this kind of scenario? Assuming that we enter a position there and we exited there, 2%, okay? Again, it's not something flashy, but still, if you're leveraged out with this kind of stuff, you can actually make money. Still, again, at the end of this cycle, at the end of this wave, at the end of this swing, at the end of the day, this is now acting as a bearish crossover. That means sell signal. So exactly the same thing. Place a short order. Let's assume you went in there, okay? And I wait for the next one, which is down there, okay? And profit opportunity for this would have been here, 3.5%. Okay, so again, this is basic swing trading using MACD as a technical indicator for our signals. Okay, using purely this without any other stuff. Okay, in order to get much more accurate with your prediction. And sometimes it works very nice, sometimes it doesn't. That's why you need to add many different other stuff onto your chart. I've been preaching this since the start of this webinar series. Do not use this kind of technical tools or technical indicators that we study solely on each and every webinar, okay, by themselves. The point here is to understand each and every one of them nicely and then use all of them together in order to have a high probabilistic chance of making money. Okay, having at the end of the day high confidence that your assessment is correct. Okay, using all these lovely indicators. Do not go simply using one. Okay, there's no point. Why use one when you can have all of them together, easily plotted on your chart, and now you know how they actually work? Why not use them wisely to your advantage? Okay, enough. So entry point, short position up there, exit point at the next crossover, which is down there. And then now we're coming much closer to what's going on at this point in time. So you entry position would have been the crossover right there. Never mind the stop out and stop loss levels. I'm not setting them up at the levels that would have been appropriate. You're just using this as a way of marking the positive territory and the negative territory. I think you understand that. So the other one would have been in regards to exit whenever you will get a crossover between the two. Okay, it has not happened yet. Let me see. Nope. Coming close to, however, that's why I'm starting to pay attention to this. And I personally would have placed significant attention on this, not only awaiting for the MACD line, okay, to cross below the signal line, but I would have been paying significant attention to the dwindling, okay, you see the slowdown of the histogram bars, okay, it's moving towards, okay, the zero cutoff point. Okay, therefore I know the bullish momentum, because it's moving to upside, the bullish momentum is wearing thin. Okay, it's losing steam, is losing momentum, and therefore I can extrapolate, or at least place in the back of my mind, you know what, I see this taking place, maybe there will be a crossover coming soon, therefore I'm going to be pulling up this lovely chart much more frequently and paying attention to it on a much shorter time frame, okay, in order to make sure that I will bank most of the move and not leave excessive profits on the table. Okay, and this comes to the different, a second approach at going at trading, or using MACD line as your technical indicator when you use when you go at trading, which is do not wait for the crossover. Okay, it requires much more attention. It requires much more sweating in front of your PC looking at price action, but at the end of the day, you're not leaving money on the table. And in this case, for example, let's assume that we saw this lovely crossover right here as a validation. Let me get rid of this. Let's assume that we've entered the position after the crossover, after you see the momentum dwindling and from bearish and becoming strongly and sufficiently strong in favor of the bulls. Okay, entered the position somewhere in there. Let's be more realistic. Okay, so I waited for the confirmation and entered the position. I would have liked, for example, as an alternative way of playing this, the entry, let's just say it's set. Let's talk about the exit point. Another way of using the MACD indicator for an alternative exit point instead of waiting for the next crossover would have been, when do you see the histogram bars peaking at? Okay, let me make clear what I mean by this. You see them steadily stepping up forming the leg up, leg up, leg up, leg up, okay? And you see them here being boldly green and then faded green, okay, in here. This is an indication that they have peaked. Therefore, after the first confirmation, if I have an itchy trigger finger and I'm not laying back and awaiting and I want to be much more active in my trading, I would be awaiting to see when does the first faded, okay, histogram bar appear, okay? And whenever I get the confirmation that the second one will also be of the same nature, because sometimes you can get a fake out. You can clearly see here. Hopefully you can see my mouse pointer here. You see a fade, the first pale or faded kind of histogram bar, but the follow-up is solid green. Okay, this is what we call a fake out, and you see again a nice rebound from there. Okay. Once I get the confirmation that the second bar is actually faded as well, I start to pay significant attention to this level, okay, as we just marked, which is down there, up there, excuse me, and exit the position, okay, which is, let's just say, somewhere in there. So we're talking about 4.10%, okay. Now, if I'm awaiting, this is, let's going back to the first scenario, which is using cutoff points as entry and exit points. So blue line crossing above red line and blue line crossing below red line. Entry here, exit whenever that's going to happen. Certainly is going to be below that. So I'm going to be leaving certainly money on the table. And if today we see the market opening at much sharper than this, we might see the cutoff below here, okay? And we, at best, we might reap a 3% instead of a 4.10%. You see what I mean by here? By not using the cutoff point, the second cutoff point as your exit target, you could use the histogram, the peak of the histogram bars as another exit point, an alternative to an exit point, which most of the times, again, comes from a personal experience. Most of the times it's a little bit much more accurate, okay? And it makes you, gives you the opportunity to not leave money on the table, okay? So in a sense, you capture more of the move because you're paying attention to it. But still, it's a different way of playing it, okay? So from something else we failed to do since the beginning, hopefully you understand the whole example, is use other stuff on your chart. Let's move, see here, this, okay? This is certainly giving you an indication where the market is moving towards to, okay? So remember, using trend lines. Do we have time, by the way? Excuse me. So a few more moments and we'll be on our way, okay? So let's add on a little bit more stuff to your charts, okay? Let's leave them there. We'll see. Okay, so certainly identifying first the direction of the market. In this kind of case, we see a higher, we see a peak there, a high, excuse me, a lower low, a lower high. This is definitely, this area here is certainly below this area. So fits the definition for a descending kind of market or downwards moving market or instrument in this kind of case, which is S&P 500. Then we have another lower low. Certainly this low is much lower than this. Okay. Then you have a lower high. Okay. Lower low, etc. This is the paradoxical part. Okay. And this is where I like to be paying some attention to, because this swing, so we have one swing, second swing, third swing, the fourth swing, okay, it has peaked above or near and above the prior peak. So again, it is not confirming 100% the descending kind of scenario. It is pretty much at play here. We might see some sort of consolidation taking place here, and then we see a breakout above it, depending obviously what's going on in the markets. But still, it's a peculiar kind of situation here. Okay, if I got a lower low, a lower high somewhere around there, imagine this whole thing being down here, much more confident that the price action will move to lower ground. But at this kind of case, we see some sort of stalling, and I will be paying significant attention, and I'm going to be using or needing, okay, to see much more validation from other stuff rather than just going blindly short here and waiting for the capitalization, capitalizing on the downside, if and only if we get a crossover between here, okay? What else can we add on our charts? Okay, we see some sort of diverging kind of wedge, if you can call it that, okay? For the time being, you see that you can buy at the low end, sell at the short end, which is pretty much coinciding with the shifts, okay? Buy at the low end, sell, in this case, not the top, okay? Maybe this would have been the exit point, but still bouncing from this kind of level and playing as a valid entry point, okay? Bouncing from it. So therefore, I'm going to be waiting for what's going on happen with this area right here, because once again, I said there's some sort of stalling at this kind of level, and I don't have a lower high. Let's color this. Oh my God, it's like a circus here. A lot of colors, like a clown. Let's do it blue. Doesn't make the situation better, but still. So I would need to see confirmation, a definitive break below this kind of level, okay, before entering a short position or covering this kind of level, this position, okay. And let's add on a few support and resistance levels in order to have some sort of targets of where, if my patience is wearing out and I'm not going to be waiting for whenever the next crossover will be, where can I exit the position using support and resistance levels? We use a trend line. Let's use the support and resistance levels. Certainly, this one will be one that I will be paying attention on the much broader kind of perspective, on a longer term view, because from the top until there is what? 5%. Yeah, I don't know how fast can the price action go down there. Maybe if we get super bad news coming out, or some sort of crisis or war or any of these kind of stuff. The other support level, in my eyes, would have been using the wrong tool. Would be somewhere in here, mainly because I see this area of bouncing once, bouncing twice. See some sort of stalling here, break below, but bouncing once again from it. This is going to be a nice target for me, much more closer. What the 42.20 area. What about resistance? Where would I cut my losses if the price action moves above from? Certainly this area right here, the prior peak, which kind of coincides with the hitting of the price action also on top of this kind of ceiling. Again, remember, let me zoom in to have a much clearer view. And yep, not better, but still, yep, much nicer. Let me remove this kind of stuff from the whole thing and focus on the much shorter time frame. Okay, this is an area, give me one sec, that I'm going to be paying attention to, and it's act as a resistance level, because you see inability to move to higher ground. Same here, stalling here, certainly an area that I will be paying attention to. And if I see the break below this kind of level down here, I may be using a short position, okay? Irrespective of the MACD. For the time being, we're long on this, okay? So what else do we have? And what kind of other indications can we take into account here? What is going on with the RSI? Yep. RSI here, the value is what? 60. The moving and the moving average based RSI is what? 64. Certainly in bullish territory. That gives you an indication that the bulls are still in control and they might be pushing prices to high ground. So therefore, if I'm gonna exit my position and start placing shorts, I would like to see the RSI pointing towards the 50, and if not, moving nicely and sharply towards it in order to exit my position, because let's assuming that we have entered the position here, I will be paying significant attention to it. Okay, now we used RSI, we used trend lines, we use support and resistance levels, we use moving average, convergence and divergence. Let's also use moving average strategies, the stuff that we covered in the past webinar. So remember, the philosophy with moving average strategies is pretty much the same with moving average, convergence and divergence. You seek out the crossovers between the two lines. Okay, in MACD is the blue line, the MACD line with the signal line. In moving average strategies, plainly, is whenever you get the short-term moving average, the black line, crossing above the long-term moving average. In this case, we see a crossover there. Okay, so a crossover there would have been my entry point, would have been up there. Certainly not good, because you see the price action stalling there. Okay, so the MACD, the moving averages are giving me the indication that a bullish crossover has taken place. Okay, that also is confirmed by moving averages. Is confirmed by the MACD line, the MACD indicator below my chart, but at a much earlier phase. Okay, because it uses the momentum aspect of the whole thing, gives you an early indication compared to moving averages plainly. Still, the signal from moving averages is bullish, but let's assume that we are using only moving averages, okay? And we have entered a position whenever the crossover occurred. It would have been, nope, not that one. It would have been certainly up there. So certainly in deep waters, if I waited for the crossover of the moving average, okay? But so the profit margin would have been something like this. I'm not sure about my tolerance with this kind of trade. Messes up the whole thing, sorry. Okay, so the signal from moving average, convergence and divergence is much later compared to this, which is going to be somewhere in there. So profit opportunity would have been much smaller, but if I waited for the next crossover of the two, and let's just say it happens somewhere in there, I'm definitely losing money straight away. Therefore, if I assume that I've entered a long position using moving averages only, and I am using the one of the alternative ways of closing the positions, which is whenever the price action crosses below the short-term moving average, I would have been out of this position with minimal kind of losses. Again, it's not about moving average today, it is about moving average, convergence and divergence, the MACD, and we just showcased how it can be used. Okay, so it's different stuff to pay attention to. Okay, so let me see. I see people sending messages in the chat. Let me address the questions. Oh yeah, Shiv, we covered this. Could you please help us with a short video illustrative guidance on how we can add the MACD and EMA and RSI on TradingView or on the platform? Platform for some reason is not working today. Having problems. Still, from here, you can go on indicators, and you can actually use TradingView for free for your charts and the execution on the MT4. Yeah, I've tried it earlier today. For some reason, is attempting to make a sort of update and it's not allowing me to enter on MT4. If I'm not mistaken, you go to view, not view, indicators. Can't remember exactly. On top left hand corner of your screen, you have file, you have view, and then you have something else. It's been ages since I've used MT4. I can't remember exactly what it is. let me try to find possibly a YouTube video, or maybe I'll make a YouTube video where how you can use this on your MT4 if it opens, and you can actually access this and watch this. Okay, so if you find on the top left hand side of your platform, if you are on there, you can actually go on the top left hand side corner, and there is a lot of different bars. I'm not sure if it's under view, but you can actually scroll through them. You're going to find a section of indicators. Once you scribble a little bit in there, you're going to find moving average, convergence, and divergence. And this is what Shiv actually told me. It's not going to be as nicely as this, but you can find a video online actually adding this kind of stuff on it. And RSI also is there. You can actually read in your chart, and you can use the parameters there. Possibly while using moving average, convergence, and divergence, you can have 12, 26, and 9 by default. RSI is going to be, if I'm not mistaken, 14 period. So it's already there still. Okay. So let me... guys, we're way past our time. I have to end this because I have to attend some other matters. Okay, hopefully this has been illuminating for you. Hopefully you understand the topics. What training solutions do you use? I use the exact same thing you can see from here. Okay, training view. So hopefully you understood the topics today. If you have any questions, please send them through. Shiv, I'm going to attend to the email you just sent me, or hopefully you just resend me the ones you sent in the past. I will hopefully I got that as well, but I didn't see any email. But still, I'm going to give you the details of what you ask. And yeah, this is the end of today's session, guys. If you have questions, please send them through quickly, or email me at webinars at T4Trade. I will answer them as soon as possible there. So see you hopefully on the next webinar. Okay, so take care. Bye-bye.